Welcome to another episode of Riffle, a podcast series brought to you by 10 Leaves. Today, we're embarking on quite a deep dive into a fascinating and, well, incredibly high-stakes corner of the financial world. We're talking fund management. Specifically, we're looking at this practice, self-custody, that's, gaining traction, but definitely comes with its own unique set of risks, where the entity managing the money also holds the assets. So our mission today is really to unpack a pretty critical thematic review. This one's from the Dubai Financial Services Authority, the DFSA. And look, this isn't just some dry report, right? It's actually a rare and I think invaluable glimpse into how financial managers over in the Dubai International Financial Center, that's the DIFC, are handling their own assets. We'll uncover, well, some impressive foresight, but also some critical areas that frankly still need serious attention. So if you're keen to understand the mechanics of financial oversight, market growth dynamics, and that delicate balance of trust versus control in fund management, then yeah, you're absolutely in the right place.
Okay, let's unpack this then.
We are seeing a pretty significant shift in the financial landscape, particularly there in the DIFC. The DFS introduced this requirement, fund managers submitting periodic fund returns data back in January 2021. And the numbers coming out of, say, the first half of 2024, they tell a really compelling story. It's about growth, rapid growth.
Oh, absolutely. What's truly fascinating here, I think, is just the sheer pace of the expansion we've seen. Between December 2023 and June 2024, just 6 months, the number of domestic funds operating within the DIFC, it surged by almost 20%. That brings the total to 153 funds. But, okay, here's the real kicker and kind of the reason for this deep dive. 30% of those funds, that's 46 in total, they were operating with self-custody arrangements, which means, the fund manager themselves is directly holding on to the assets, not using an independent third-party custodian. It's a fundamental shift, really, in responsibility.
And in risk?
30%, that's a substantial portion of the market, isn't it?
It is.
And we're not talking about small change either, I assume. When firms opt for self-custody, what kind of assets are we typically looking at? And what's the scale, the money involved?
Precisely. Yeah, not small change at all. These 46 self-custodied funds, they accounted for a staggering USD 3.8 billion in assets under management, AOM, which works out to, well, a whopping 45.5% of the total domestic fund AOM in the DIFC for that period, H1 2024.
Almost half. Exactly. So it's not just some niche trend. It's a really significant segment of the market by value. Now, most of these funds, about 83% actually, were qualified investor funds, QIFs. These are, funds designed for very high net worth individuals or institutions. They allow for more tailored risk profiles, often less stringent oversight compared to public funds.
Right. For sophisticated investors.
They were followed by public funds. Those are open to retail investors, strictest protections, and then exempt funds, also catering to more sophisticated types. And if you drill down into the asset types, property funds were by far the most common. They made up the largest share, followed by private equity and venture capital. And in terms of structure, the majority are set up as closed-ended investment companies.
Okay, so for you, the listener, what this paints is a picture of a rapidly growing financial market, right? And a significant multi-billion-dollar chunk of it relies on these firms managing their own assets directly. That context is just absolutely crucial as we delve into the DFSA's review. Because, when the manager is the custodian, the whole dynamic of trust and oversight, it changes entirely. So given this burgeoning market, the significant assets under self-custody, the DFSA quite rightly decided to conduct this comprehensive thematic review. And here's where it gets really interesting for us. How did they actually approach this? What were they specifically looking for? What was the methodology?
Yeah, it's a good question. It touches on how regulators keep pace, right? The DFSA adopted what they call a risk-based approach, basically focusing their efforts where they saw the highest potential for issues, for vulnerabilities. So instead of just sending out a broad survey to everyone, which can be burdensome, they did a targeted review. Made sense, given the relatively small population size here. 23 fund managers, 46 funds identified using self-custody. From that group, they identified a sample of 10 firms they considered higher risk, and they made sure this sample covered all the fund types. Public, exempt, QIF, and different operating structures too, like open-ended and closed-ended. The goal was a truly holistic view of market practices, deep scrutiny where it mattered most.
A focused, almost surgical examination then?
Exactly.
And what were those critical areas of concern, the key themes that emerged from analyzing these targeted firms?
So the review zeroed in on 4 major risk areas. These are particularly relevant, you see, when a fund manager is also the custodian they looked at. Operational risk, conflicts of interest risk, transparency and disclosure risk, and finally, liquidity risk.
Okay, the 4 pillars.
You could call them that, yeah. pillars of potential vulnerability in this self-custody model. They tested the fund managers against specific rules in their rulebook, the Collective Investment Rules, or CIR module, tailored to each fund type, of course. And an important part of the review, something they looked for, was whether exempt funds and QIFs, which often have less prescriptive rules, were voluntarily adopting the stricter standards usually applied to public funds.
So looking for proactive risk management, not just ticking boxes.
Exactly. Demonstrating a commitment beyond just the bare minimum required.
That's a great framework. Let's break these risks down one by one, starting with operational risk. This sounds like the nitty-gritty, right? The mechanics of how things are actually done day to day.
Yeah.
What did the DFSA expect, and what did they find?
The expectation here is, well, it's absolutely clear. Fund managers need robust written policies and procedures, specifically for self-custody. This means ensuring fund property, the assets actually belonging to the fund, is completely segregated from the manager's own assets, kept separate.
Like a lawyer's trust account versus personal funds, but bigger scale?
Exactly that kind of principle.
No.
But for billions of dollars. The policies also need to detail how assets are secured, clear rules on access, who gets it, under what conditions. Now, we did see some good practices. Some FMs maintained meticulous electronic custody registers for their real properties.
Yeah.
Clear, detailed ownership records. Others had comprehensive operations manuals for each fund, outlining the custody arrangements very clearly. In some of the best cases, the legal title to real property, registered directly in the fund's name, not the manager's name. That's a critical distinction.
Very important, yes.
And crucially, some FMs had dedicated employees just for safeguarding ownership documents. And these people were independent of conflicting duties like finance roles. Adds a vital layer of internal control.
Okay, those definitely sound like solid foundations for security, good building blocks. But knowing the DFSA did this review, I'm guessing there were cracks. Where did things fall short? What were the shortcomings they found in these operational setups?
Unfortunately, yes. This is where the picture gets a bit more concerning. The review found that the majority of the fund managers they looked at actually lacked appropriate written policies and procedures specifically for self-custody.
The majority. Wow.
Yes. And even where policies did exist, weaknesses were identified. Like policies weren't being periodically reviewed or updated, maybe didn't reflect current practices or new asset types. And there was one particularly concerning instance.
Go on.
Where the fund manager itself, not the fund, was the shareholder of the special purpose vehicle. You know, the legal entity set up to hold specific assets for the fund that SPV owned the underlying assets. But the FM owned the SPV.
Okay, that sounds problematic. Why is that bad?
Well, it's not just a legal technicality. It completely blurs the lines of ownership and protection. It creates this direct legal vulnerability where the fund's assets could actually get entangled with the FM's own liabilities if the manager, say, faced financial distress or even bankruptcy.
Right. So the investor's money isn't properly ring-fenced.
Precisely. It fundamentally undermines that segregation of assets that's meant to protect their capital. In another case, legal ownership documents weren't even held with the fund manager. They were with third-party property managers.
Adding another layer of risk.
Exactly, an unnecessary intermediary risk. These are critical gaps. They expose the fund to potential mismanagement, misappropriation, or, even legal challenges down the line.
That's a stark finding. The idea that the protector could inadvertently be the source of exposure. So, okay, robust operations are vital. But even watertight systems can be compromised if the people running them have conflicting interests, right? Which brings us directly to that thorny issue, conflicts of interest risk. When the fund manager is also the custodian, why is this such a big deal and how are FMs managing it or failing to?
Yeah, this really goes to the absolute heart of trust, fiduciary duty. When the same entity is managing the investments and holding the assets, there's just an inherent and often quite complex potential for conflicts. For example, a manager might be incentivized to hold on to less liquid assets if selling them would negatively impact their own balance sheet, even if selling is actually in the unit holder's best interest.
I see. Their interests aren't aligned with the investors.
Potentially, yes. So FMs are expected to ensure employees handling custody are independent of those managing the investments. Their policies have to cover how to prevent these conflicts, manage them when they arise, and crucially, disclose them fully to unit holders. Protect investors from biased decisions. We did see good practice here. Some FMs actively assessing potential conflicts, really drilling down, discussing them internally, maybe at a committee level, documenting them thoroughly in compliance manuals, and, maybe most importantly, disclosing them clearly, comprehensively to unit holders in the fund documents.
Okay, so some were doing it right, but where were the improvements needed?
Well, the review found that some policies didn't adequately cover the specific conflicts that arise just from self-custody. They were maybe too broad, too generic. And, importantly, there were insufficient disclosures in the fund's private placement memoranda, the PPMs, or their prospectuses.
Those key documents investors rely on.
Exactly. The essential legal docs outlining terms, risks, strategy before you invest. If the conflicts aren't spelled out there, investors are left less informed about potential biases.
Right. Even with strong operations, managed conflicts, if investors aren't fully informed, they just can't make intelligent decisions. Which leads us to transparency and disclosure. What were the DFSA's expectations here for clear communication? How did firms measure up?
Simply put, FMs must make appropriate and timely disclosures about their self-custody arrangements. This needs to be in those PPMs or prospectuses, which investors get before committing capital. And also in periodic reports, so investors stay informed throughout the life of their investment. You need to know how your assets are being held and the specific risks involved.
Seems pretty fundamental.
It is. Now, interestingly, no FMs were identified as going above and beyond normal practice here. No one was really innovating in disclosure. But those without deficiencies were deemed to be meeting expectations. They were doing what was required. The main failing, though, was that some FMs just didn't include appropriate disclosures in their PPMs or prospectuses at all.
Not at all.
Not adequately, no. And in one particularly concerning case, these self-custody arrangements weren't even disclosed in the periodic reports to unit holders.
Wow, so investors might not even know after they've invested.
Precisely. So for you, the listener, if you're looking at a fund using self-custody and it's offering documents don't clearly spell out the procedures, the risks, how conflicts are managed, you're missing critical pieces. You can't properly assess the security of where your money is truly being held. It directly impacts your ability to gauge the risk.
That feels like a fundamental breakdown of trust, doesn't it, when basic information like that is missing? Okay, our final risk area, liquidity risk. This is particularly relevant for certain types of funds, right, where investors expect regular access to their capital.
Indeed, yes. Liquidity risk was specifically looked at for open-ended domestic funds. These are the funds where investors can redeem their units regularly, expecting to get their money back within a defined time frame. The DFSA expects appropriate systems and controls to manage this, ensuring the fund can actually meet those redemption requests without having to do a fire sale of assets at a loss, or blocking investor access gating.
What would good controls look like there?
Well, things like robust cash flow forecasting, maintaining a decent cash buffer, having access to different funding lines just in case, and regular stress testing, seeing if the fund could handle big redemption spikes in bad market conditions.
Makes sense. Prepare for the worst.
Unfortunately, in this review, no examples of such strong practice were identified among the firms reviewed, specifically in relation to self-custody impacting liquidity. In fact, one FM was found to lack adequate systems and controls for liquidity risk management entirely, as required by their own rules, CIR Rule 8.6.8.1.
Entirely lacking. That's worrying for investors.
Very worrying. For you, the listener, this means a potential and very real challenge in accessing your funds. If a self-custodied fund, maybe holding illiquid assets like property, suddenly faces a wave of redemption requests and lacks these controls, investors could face significant delays getting their money back, or even receive less than expected if assets have to be sold off quickly at a discount.
Okay. So we've covered the risks, the findings, inadequate operational policies, gaps in transparency, conflicts, critical liquidity issues. But who's ultimately keeping an eye on all this within the firm? What about the internal oversight? Risk mitigation? Who's the internal watchdog?
Yeah, connecting this to the bigger picture.
Yeah.
The DFSA expects robust internal oversight mechanisms, absolutely critical. Compliance officers, for instance. They're meant to be actively monitoring self-custody arrangements through their regular compliance monitoring program, checking alignment with rules and the firm's own policies. For public funds, with that broader investor base, there should be an independent oversight committee actively reviewing these arrangements. And crucially, firms really should consider internal audit reviews where it makes sense for their business size and complexity. Get that independent assessment of controls.
Did they find examples of good oversight?
They did find one standout example, actually. One FM subjected its self-custody arrangements to reviews by two separate governance forums, and comprehensive reports went quarterly to the FM's board.
Two forums, quarterly board reports. That sounds robust.
It really does. It demonstrates a strong commitment to governance, multiple layers of review. That's what you want to see when billions are involved.
That's excellent. Definitely a high benchmark. But I imagine there were also areas where oversight fell significantly short, perhaps indicating a broader issue.
Unfortunately, yes. That's precisely what the review found across the sample, several significant failings. Some fund managers simply didn't include a review of their self-custody arrangements as part of their firm's compliance monitoring program at all.
Just not on the checklist.
Effectively, yes. A huge blind spot if compliance isn't even looking at it. Where reviews did happen, compliance reports often lacked sufficient detail. They didn't really demonstrate how arrangements were assessed for adequacy, looked more like a tick box exercise than a substantive review.
Not digging deep enough.
Exactly. And remarkably, none of the FMs reviewed considered subjecting their self-custody arrangements to internal audit.
None, really.
None. Which is a major red flag. Internal audit provides that crucial, independent assurance that controls are working effectively. This suggests a pretty significant gap in independent assurance and effective monitoring across much of the sample population, which, substantially increases the overall risk profile for investors in those funds.
Okay. This deep dive into the DFSA's thematic review, it really offers a powerful snapshot, doesn't it? A rapidly evolving financial landscape. We've seen this domestic funds market experiencing incredible growth, yes, but with a substantial slice opting for self-custody. And while some fund managers are clearly setting high standards, implementing robust controls that others should probably emulate, many still have critical work to do, shoring up operational controls, managing those conflicts, enhancing transparency for investors, and ensuring genuinely robust, independent oversight.
Absolutely. And the takeaway here, I think, isn't just about ticking compliance boxes. It's really about those fundamental principles, investor protection and market integrity. The DFSA's proactive stance here, conducting this review, highlights that ongoing need for vigilance in what is a complex financial ecosystem. This review really serves as a clear call to action for fund managers. Assess your practices, strengthen them, and it's a valuable insight for anyone involved or just interested in the financial sector. It emphasizes that market growth. It must always be accompanied by strong governance and that unwavering attention to risk.
So what does this all mean for the future then? As markets keep innovating, new models like self-custody become maybe even more prevalent. How might a review like this influence standards, not just locally in the DIFC, but maybe broader global standards for managing assets, mitigating risks, especially in regions where regulatory frameworks might still be catching up? It leaves us with a pretty compelling question, I think, about the continuous evolution of trust and regulation in finance, and how we ensure investor confidence keeps pace in this ever-changing landscape. Thank you for joining us on this deep dive. Welcome to another episode of The Riffle, a podcast series brought to you by 10 Leaves.